All right, guys, I got 1 minute past 5:30. So just to stick with time, why don't we get things started with tonight's presentation on investing in real estate? We got a lot to cover in the next 60 minutes. And is Christine put in the chat there? If you have any questions throughout tonight's presentation, please put any and all questions into the chat, and I'll be sure to address them before I get logged off tonight. So any questions that pop up, anything and everything, put in the chat and we'll get that to all questions at the end. So starting out, let's do a quick overview of what we're going to discuss tonight with investing in real estate. We'll start out really with an overview of who we are, who am I, who's Patrick Kappel and my team, and then we'll teach tonight's topics by way of case studies, and we'll cover real world examples in investment real estate that we've seen in the last couple of years. The first case study, we're going to go over real estate financials and show you how you can take advantage really of other people not understanding real estate financials so long as you do. Case study number 2 is going to cover zoning. And I'll be the first to admit that even most realtors in San Diego don't understand zoning. And you'll know more about zoning by the end of this webinar than most people in San Diego. Next, we'll go into case study number 3, which is a 1031 exchange. Some of you may know what a 1031 exchange is. Some of you just kind of familiar and you're here to learn more. So we can't cover everything about 1031 exchanges in 1 hour, let alone the segment of tonight, but we'll cover enough for you to have a broad understanding of them. And then we'll talk about tax advantages of real estate versus other modes of making money. And we'll discuss cash flow versus appreciation, a question I get quite often. I'll start out by saying that 90% of America's millionaires made their millions through real estate investment. And there's a reason for that. There is no investment in the world, and certainly not in the United States of America, that has more tax advantages and more growth potential to launch you from really having nothing to being a multimillionaire in one lifetime than real estate. I have seen countless clients of my team end up becoming millionaires within a short matter of time, many of them multimillionaires, simply by investing in real estate. So with that, who am I? Who is my team? My name's Patrick Kappel. I am the owner of a brokerage team called Kappel Realty Group. I personally have over 13 years of experience in the San Diego real estate market. I own 8 properties throughout San Diego. I'm a board member of the Southern California Apartment Association. My team, we're pretty active. We sell a little over $10 million per month in San Diego real estate. Last year, we sold just over 140 million, which was composed of 250 units throughout the county. I'm also in the Navy, 22 years now, believe it or not. I've been in the Navy 22 years, and I'm currently serving in the Navy Reserves 1 week a month. Education, you see there in the middle, bachelor's degree from the U.S. Naval Academy, followed by an MBA with a focus in finance and real estate at UCLA, and a Master of Science degree in real estate from our very own University of San Diego. A bunch of awards there on the right. My team, it seems, is winning awards just about every quarter, and it's because we've become one of the foremost teams in San Diego that does educational outreach like you're seeing tonight. And why do we do all this educational outreach? Because I've learned, I've been in your shoes. I started out owning nothing. When I started these webinars, at the time, my parents had just bought a house actually, but I owned nothing when I started out in real estate, had very little money, and it was scary. And the only thing that got me over that fear was those 3 degrees you saw. Getting an MBA in finance, a master's degree in real estate certainly gets you over any fear that you have or misunderstanding that I had about real estate. And I'm here to share what I've learned through all those degrees and all my experience, so that hopefully when you go out there and buy or sell real estate, you do so more confidently. You can communicate with me by any of these methods you see in front of you. The best is email. I will almost always try my best to get back to you within 24 hours if you shoot me an email. But you also see my phone number. I highly encourage you to follow us on Facebook, and you'll get the latest and greatest on what's going on in the marketplace. And we'll invite you to all of our upcoming webinars. We do about 2 webinars, all educational, based on real estate, twice a month. And I'd be happy to see you guys at all the future webinars that we do as well. So again, why do I do these webinars? Again, knowledge empowers you. You guys are going to learn more in the next 55 minutes than most realtors and most people in this business will learn in a year or two. Because what I've done is I've compacted some really powerful and important knowledge down into about a 55 minute presentation for you. And again, my team works in brokerage. We work with buyers and sellers all the time. And I've come to learn that there's only one thing that stops our clients and consumers from making a decision, and that's fear of the unknown. And there's only one way to get over fear of the unknown, one way, and that is knowledge. So hopefully some of the knowledge I share with you today kind of enlightens you, opens your mind, helps you look at real estate and finance and economics the way a real estate investor does. Most importantly, gets you over any concerns or fears or hesitations you have while answering some questions. Again, can't answer all questions in 60 minutes, but I'd be happy to have my team work with you after this presentation. You reach out to me at those numbers I showed you. Well, let's start out with case study number 1. Case study number 1 talks about real estate financials. And this property is near and dear to my heart because it's one that my wife Grace and I actually purchased years ago now, 2017. Guys, when I got into real estate brokerage, I had already been an investor for almost a decade. I went and worked in commercial real estate brokerage, brokering apartment deal complexes. And then I went into residential real estate and I learned something really quick. And what did I learn that ended up being very advantageous? That is that most residential realtors and most mom and pop investors, people like you and me, most mom and pop investors and most residential realtors do not understand real estate investment finance. Because they don't understand it, you can find a lot of errors and mistakes that other people make every single day in real estate. What I'm showing you here right now is an MLS sheet, multiple listing service. And on an MLS sheet, you see all the cool stuff like photos and address and the price they want to sell it for. But on 2 to 4 unit investment properties, you also see something special. And that's down here in the bottom left. That's the financials for the property. What's the income? What's the expenses? What's the cap rate? What's a gross rent multiplier? What are the projected expenses and incomes? And I noticed on this duplex that most of these financial numbers were blank. They weren't even filled in. I see this 9 out of 10 times, over 90% of the times, guys, in 2 to 4 unit properties listed on the MLS. When I see a 2 to 4 unit listed on the MLS and all this stuff is blank, that tells me right away that the broker representing the seller and the seller probably don't know what they're doing. And a lot of times they'll overprice it, but now and then they accidentally underprice it. Now, am I telling you to take advantage of other people? No, not outright, but I am telling you that knowledge is power. And I'm telling you, if you've got the knowledge and you understand the real estate financials and where to identify the mistakes, where they are and where they aren't, you can take advantage of situations. And anyone working in this business who doesn't understand the financials they're out of their league and they shouldn't be doing so. And if that means you swoop in and you take advantage of the situation, knowledge is power, then so be it. And the situation I noticed on this one immediately, which to someone who doesn't work in the business might not notice it right away, but this is a duplex in Linda Vista, 3-bed, 1-bath, and there is a huge mistake on the sheet of paper in front of you. And the mistake is in the financials circled here in the bottom left. Specifically, that mistake is the rents. The broker selling the property and their client, they had completely renovated this property. So there's no tenants in it right now. That's why they put down actual rents is 0. And the broker selling the property said, hey, I think that we could probably get $1,950 per month per unit. My team works, sleeps, breathes, eats in this market 24/7. We know it inside out. And I knew that there is no way I am renting these units, 3-bed, 1-bath in Linda Vista for $1,950 a month when they're completely renovated. I got a front yard and a backyard. I'm going to get at least $2,500 per month per unit. That's a fatal mistake this guy made. And guys, I don't know what industry you work in. It might be tech, it might be military, it might be medicine, you might be a teacher. I don't know what industry you work in, but you know one thing about your industry. If you can find other people's mistakes in your industry, you'll rise to the top. And in investment real estate, if you can find other people's mistakes, you will succeed. So that's a clear, blatant mistake that we saw in the MLS. And as I see over here in the paragraph over the left, you see that I wrote in that with $19.50 a month, guys, there's no way I would have paid a penny over $700,000. And they were advertising it $699 to $749. I wouldn't pay a penny over $700K if I thought I could only rent for $19.50. But knowing that it could rent for $2,500 a month, something the seller and their broker didn't know, I would have paid $800,000, if not more, for this property. So the seller and their broker, their realtor, they misadvertised this property. And that was a fatal mistake. I ended up buying this property for $728,000. Again, that was back in 2017. And I would have paid $800,000. That seller lost around $75,000 because they hired the wrong realtor that didn't understand the financials down here. Now, I know why they did, because that's what we call a discount broker in our business. What's a discount broker? Discount broker is a brokerage or a realtor that works at a discount fee. They're a dime a dozen throughout the nation, throughout San Diego, but they usually will give you that discount knowledge as well. And this is a case where I would say that seller tried to save 1 or 2%, $7,000 to $14,000 on a commission. And in doing so, they lost $75,000. Fatal mistake for them. Awesome opportunity for me. This is the type of stuff that we look for our clients all the time. Other people's mistakes. And guys, I learned that in the Navy. When I was in the Navy, I was an officer, and I started out enlisted, became an officer, and they taught us our job is to find mistakes, because if you don't find mistakes, people die, equipment fails. So I started going through the MLS and looking at all the 2 to 4 units for sale in San Diego. And I quickly found that, again, over 90% of investment properties listed for sale in the MLS have gross errors and mistakes in the math calculations, or worse yet, they're blank. In this one, you can see I marked it up chicken scratch with my pen and ink to correct all the errors that I found. But some of them, like this one before you on Beach Avenue in Chula Vista, the realtor didn't even fill out the blanks down here. They left things like the gross rent multiplier blank. They probably don't know what a gross rent multiplier is. Net operating income, annual expenses. How can you leave the actual and the projected blank? Easy, because they don't know what they're doing. So again, in this business of real estate investment, if you want to succeed, you don't need to find off-market properties. You don't need to door knock. You don't need to send out mailers. All you need to do is be educated and understand investment real estate, and then go out and find other people's mistakes. Mistakes are right out in front of us every day in the MLS. I told you I own 8 properties in San Diego. Every single property I bought, I've purchased on the MLS. And people say to me, they're like, Patrick, you're a realtor, you got a big team, lots of listings. Why don't you buy deals off market? I don't buy deals off market because I find enough mistakes from other people on the MLS that I can take advantage of them and buy stuff for less than it's worth. So that's really the easiest, most in-your-face way to make money in real estate. But there's other ways, guys. Let's talk about zoning for a second. Zoning is another one of those unique, what we call in finance, arbitrage situations. What does arbitrage mean? Finding value where value should not be. And here's how you do it in zoning. Fortunately, zoning is one of those things that most realtors don't understand. Most real estate investors in San Diego don't even understand unless they're highly sophisticated. So why is that? Why would realtors and brokers and title reps and lenders and even some investors not understand zoning? It seems like a pretty basic concept. They don't understand it because in the 1970s, in the city of San Diego, the government said, you know what, let's redo all of our zoning. So in the 1970s, before computers were really mainstream, San Diego redid all the zoning for the city of San Diego, and the new zoning never made it to title records or to tax records. So when you look at the surface of a property, just on a property profile or a tax record, and you see zoning like on this property, which is a fourplex I sold for a client. You see the zoning is R3, restricted multiple. And this is straight from a titled company property report. Guys, I'll be the first to tell you, in San Diego, there is no such thing as R3 zoning. Simply doesn't exist in the city of San Diego. Before 1970, it did, but not since then. So most people, though, would look at this and be R3 zoning. And then not really knowing what they're talking about, they would say, oh, that must mean I can have 3 units. So this owner of this fourplex came to me one day and he said, hey, Patrick, my friend told me I should talk to you about selling my property. But I'm telling you right now, Patrick, I'm not going to hire you because I've already got a longtime realtor that I'm friends with and I've worked with for over a decade, and that's who I'm going to work with. So I'm not going to hire you, Patrick. But do you mind looking at my property? And I was a nice guy. So I said, sure, I'll take a look at your property. Let's see what you got. You guys, I hear that all the time. I'm going to hire my friend. I'm going to hire my uncle. I'm going to hire my cousin's brother's sister. Like, people always like say they want to hire some random person because they know them, not because that person is good at real estate. So that was kind of the situation this person was in. And I said, all right, give me 10 minutes. Let's look at your property. I'll give you some advice. What do you think's going on with it? And they said, well, our property's got 4 units. Our realtor that we're hiring told us it's zoned for 3. So we're wondering how we can market this. And I said, huh, that's interesting. Let's take a deep look at it. And we pulled up this property report, and I quickly saw why their realtor thought it was zoned for 3, because this little zoning thing down here. And I said, well, sir, did you know that your property might not be zoned for 3 units? It might be zoned for more. It might be zoned for less. And they said, how do you know? And I said, I don't, but I know the source that we have to go to look it up. And guys, look, you don't need to know everything. Nobody knows everything in this world, but what you do need to know, in whatever profession it is you work in, is the sources to go to find information. And if you want to find out what a parcel of land in the city of San Diego is zoned for, there's one place you go, and that's the City of San Diego Development Services webpage under the zoning section. So I took these people to the zoning section. You can see the address right up there. You can all access that. And we looked up the property at zone RM-3-9. So what does RM-3-9 mean for that consumer? Well, it means that their lot can have 1 dwelling unit for every 600 square feet of lot size. And you pull that up, guys, from chapter 13 of the San Diego Municipal Code. So we pulled it up for this gentleman and his wife, and I said, sir, we got to look at the size of your lot to see how many units you can build and legally have on your lot. So we went back to his lot size, and we saw it was over 4,000 square feet. Again, it's zoned not R3, it's zoned RM-3-9, the new 1970 zoning. When we did a little bit of math, we took 4,013 square feet as lot size, divided it by 600 square feet per dwelling unit for the zoning on that lot. We found out that the calculation came to 6.68. So he said, well, what does that mean? I could build 6.6 units. The good news is, when you look this up for any parcel in San Diego, guys, if it ends in decimal 5 or greater, you get to round up. So for this gentleman, I looked in the face and I said, no, you can build 7 units, most likely even more, on your site. So you got 4 right now. You can build at least 3 more, and probably another 1 or 2 is ADUs, and maybe even more if you put in some, I hate to call it, but it's low income housing, affordable housing, or if you put in some property, some units that are near trolley stops, and you can limit your footprint for parking or near mass transit priority areas. So after learning that, he said, Patrick, you know what? I'm not going to work with this other realtor. I'll work with you and your team. It seems like you know what you're doing. You're best to market the property. And we did. We marketed the property based on the location, the development potential. This is a write-up that we had in the MLS, letting every developer out there know it's zoned RM-3-9. You can build up to 7 units, possibly even more. And immediately the seller said, no wonder we had received so many unsolicited offers at much lower prices. Guys, there's 2 types of investors in real estate: those that know what they're doing and those that don't. Most don't know what they're doing when it comes to 4 units and less. Now, if you get to 10, 20, 30, 50, 100 unit apartment buildings, everybody knows what they're doing. But when you get in the small mom and pop normal consumer type of investment properties, like duplexes, triplexes, fourplexes, single family homes, guarantee you 90% of people don't know what they're doing. And if you're that 10% that knows what you're doing, or you're working with someone that knows what they're doing, you can take advantage of it and make a lot of money through real estate investment pretty quick. So thank God this seller didn't accept one of those unsolicited offers and waited until it was properly marketed. So what do you do when you sell property, especially this seller? He had bought the property for about $1 million less than what he was eventually selling it for. So one thing that most real estate investors will do to grow their wealth and to avoid paying any taxes at all is something called a 1031 exchange. So what is a 1031 exchange? Well, it's simply selling one property and using the proceeds to buy another property of equal or greater value. So in this case, let's say you buy a home for 300K or a condo for 300K. 5-10 years go by and you sell it for 500K. You sell it and roll the proceeds into $1 million property. That appreciates. Years later, you roll it into a 1.5. Years later, you roll it into 2. Years later, you roll it into a 2.5. And over a lifetime, you swap until you drop. In other words, you keep exchanging up until you die. And most real estate investors, especially those that start at a young age, can easily start out with a $500,000 property that by the time they're in their 60s, 70s, or 80s, they have a $2.5 million property and they never put any of their own money into it because they kept 1031 exchanging up. And as long as you 1031 exchange up, you don't pay any taxes at all on any of your gain from the sale of the property that you owned. No taxes. And the cool part is what happens after you die. Not that death is cool, but what the government does with your assets, or more importantly, what they don't do with your assets, is what's pretty amazing. Let's say you start investing in your 30s and you start out with a $500,000 condo. And over the next 40 years, from your 30s to your 70s, you trade up and you swap properties about 7, 8, 9, 10 years. You let some appreciation happen, 1031 exchange up. Appreciation, 1031 exchange. When you eventually die, hopefully in your late old age, you leave this $2.5 million apartment to your children. Now, if you sold this the day before you died, you would owe taxes on all the capital gains you've had up to that point. But if you wait until the day you die and you pass away and you leave this $2.5 million asset to your children or any of your heirs, they can sell that property for $2.5 million and not pay any taxes on it, because the government does something called a step-up cost basis. In other words, the IRS pretends that your heirs acquired the property at a purchase price of 2.5 million. So if they sell it for 2.5 million and they purchased it for 2.5 million, they got 0% gain and they don't pay any taxes. This is a huge loophole in the IRS tax code, guys. And this is how families that are worth millions and millions of dollars keep millions and millions of dollars in their family without paying taxes. Real estate is one of the best tax shelters there is. So let's go on a real world 1031 exchange. This is a property owned by one of my good friends, Brad. He and I went to the Naval Academy together, and he bought this duplex on Georgia Street. It's in North Park. He bought it in 2014 for $726,000. Now, the cool thing is he bought this duplex with $0 down. How did he do that? He's a military veteran. He bought it with a VA loan. He lived in one unit, rented the other. So he bought a $726,000 duplex, 0% down, owned it for a number of years, lived in it for a year or two, and then he moved to Florida. He turned both units into a rental. And eventually he came to me in 2020 and he said, Patrick, I want to sell it and do a 1031 exchange, what we just talked about. And I said, great, let's sell it. We sold it for just over $1 million. So he made $295,000. How do you make that? Well, what's 1.02 minus 726? That's how much of a capital gain he made through appreciation on the sale of that property. Now, he would normally have to pay taxes on that $295,000. It's rare in America that you can go out and make almost $300,000 and not pay any taxes on it. But wouldn't that be cool if you can make over $250,000 and not pay any taxes on it? That's how real estate investment works. He made $295,000 and didn't pay any taxes because he rolled the gain into another property of equal or greater value. This is a 1031 exchange. And he rolled that $295,000 into 1484-90 15th Street, a fourplex in IB, which he purchased in 2020 for $1.05 million. Just a little bit more than what he sold Georgia for, but he's able to double his units and able to grow his cash flow by having more tenants with more rent coming in. Now, there's a few stipulations to a 1031 exchange, like we had to close on this fourplex within 180 days of selling a duplex. We also had to identify this fourplex within 45 days of closing on the duplex. But there's certain unique things that we can do in brokerage, and we do with all of our clients, to extend those identification timelines for our clients so they have more time to go find their next property. So in this situation, $295,000 gain, rolled it into 4 units. This year, 2020, this fourplex appraised but for $1.55 million. It went up over $500,000 in just a couple of years. And you might think, how to go up $500,000 in just a couple of years? A couple of reasons. One, economics. In San Diego, we have one of the biggest shortages of housing that we have ever had in the history of San Diego, and one of the highest levels of demand that we've ever had in San Diego. If you've ever taken an economics class in college or back in high school, you understand Econ 101 comes down to one thing: supply and demand. That's why prices are going up so quickly. And number two, he did some light renovations, new paint, some new flooring, some light renovations to it to get that value up. So in this case, we look at Brad's situation. He went from the duplex to the fourplex, bought that duplex with 0% down, VA loan, now owns a fourplex worth $1.55 million, hasn't paid any taxes on any gains because he did a 1031 exchange. So when you take the $1.55 million it's currently worth, and you subtract the amount he invested, $726, which he really didn't even invest because he put down $0, the VA loan, the guy made over $800,000 tax-free in 8 years. Guys, there are very few ways in this lifetime that you can make over $100,000 a year tax-free with 0% invested. That's exactly what he did. Now, some people might come in with a down payment, 5% down, 25%. That's fine. You can certainly do a down payment. You'll get your money back out when you sell or do a cash out. But this is an example of how anyone, Brad, me, you, anyone can build wealth rather quickly in 10 years or less by doing it through real estate. And he can turn all that equity. You might think, well, yeah, it's $800,000, but it's all equity in his property. He can turn that equity into real greenbacks, real dollars in his pocket by doing a cash out refi or just selling the property. Now, a cash out refi allows him to access all $800,000 tax-free. And you pull all that money out tax-free. I do it all the time in my properties. Most of my clients do it. Or you could just sell it, in which case you'll pay a long-term capital gains tax rate, which we're about to get to. So let's talk about taxes. Let's talk about investing, 401ks, and real estate. Why is real estate a better investment than the best 401k or IRA than you can ever imagine? Because of taxes, guys. Taxes. Now, let's do a little quick lesson on taxes. I'm not a CPA, so I'm not going to give you a 5-hour lesson on taxes, but I'm going to tell you what everyone on this webinar should know at the very minimum. In the United States of America, as my sister likes to say, we have 2 tax systems. We have one tax system for those who understand taxes, primarily the wealthy. We have another tax system for everyone else. 90% of Americans probably fit into that category, everyone else. You might think that's you. If you don't understand taxes, it probably is. So let's understand just the very basic. There's two ways to make money in the United States of America. And those two ways are taxed completely differently. The one way that most of you are familiar with is through work. Most people make money through work. They grind it out 9 to 5. If you make your money through work, that money is going to be taxed at the highest tax rates in America. And you see those in this table on the left. That's called income tax rate. It's also known as short-term capital gains tax rate. This is the worst way to make money from a tax perspective because Uncle Sam takes a huge bite out of it. Now, then there's the other way to make money in the United States of America. And that way is by doing nothing. The funny thing is, if you make money by doing nothing, the government taxes you less than if you make money from work. So what is that tax rate for doing nothing? It's also known as a long-term capital gains tax rate. And you can see over here for single people on the left, married filing jointly on the right, that if you're single, your first $41,000, if you're married, your first $83,000 isn't even taxed. And for a long-term capital gains tax rate, if you're married, your first $431,000, almost $500,000, is taxed at 15%. Look at that. But if you made that money through work, it's taxed twice as much, 32%. I don't know about you guys, but if I'm paying taxes, I'd much rather pay 15% than 32%, 15% than 22%, 0% than 12%. So those who really build wealth through investments focus their investment efforts on investing in assets that are going to get taxed as a long-term capital gain, these columns on the right. And those who do not understand taxes focus their investments on cash flow. Now, here's the secret of cash flow, guys. Cash flow is taxed as ordinary income tax. Cash flow, is taxed in this high tax rate. Appreciation, first of all, isn't taxed at all until if and when you sell. And if you do sell, it's taxed at this low tax rate. If you do a 1031, it's not taxed at all again. This is why I, my friends, my family, and most of my clients invest for appreciation, not cash flow, because we don't like all of our gains going to the government. So here's a quick chart I put together that differentiates what gets taxed as ordinary income, the high tax rate in this country, and what gets taxed as long-term capital gains, the low tax rate in this country. Well, as you can see on the left, I already mentioned it. Any money you earn from work or a job, high tax rate. Any cash flow that you get from most investment dividends, high tax rate. Any cash flow you get from investment real estate, high tax rate. On the right, any capital gain that you get in certain investments. You buy some stock or some other investment, you hold it for a number of years, it goes up in value, long-term capital gain, low tax rate. Appreciation of real estate, long-term capital gain, low tax rate. And again, real estate is the only investment in America in which you can do a 1031 exchange. You used to be able to 1031 exchange all kinds of investments. You could 1031 exchange artwork back in the day, like a Da Vinci or a Picasso. In this day and age, the only thing that you can 1031 exchange and buy, sell one of it and buy more of it is real estate. So real estate, if you do it right, you'll make hundreds of thousands, most likely millions in your lifetime, and you'll pay very little to no taxes on it. But if you're chasing cash flow, guys, you're going to pay a lot of taxes, and you're not going to become half as wealthy as you could have become otherwise. So let's look at case study number 4, a capital appreciation play. Now, what you see before you is a 3-unit triplex down in IB. A couple of clients came to us. two young guys, actually, Navy officers. These two young Navy officers come to us and they're like, hey, we need a place to live anyway. We don't want to rent. So let's go buy a place and live in one unit and rent the other two out. And it was 2020. We bought this triplex for $890,000, or I should say they bought this triplex for $890,000. And at this point in the story, it's worth saying this. It was 2020, guys. What was going on in 2020? The pandemic was just beginning. A lot of people were nervous, a lot of people fearful, rightfully so. They didn't want to do anything with their money, so they sat tight. They didn't do anything. Well, you know what deer that crosses a road gets hit by a car? The deer that freezes and looks at the headlights. When things are going awry, that is not when you freeze and do nothing. When things are going awry, when there's a recession, that's when you take action. And these two young Navy officers, many of their friends and all of their family told them it would be foolish to buy. But guys, unless your friends and your family have master's degrees in real estate and finance, I wouldn't take real estate and financial advice from your friends and family. Take life advice, take marriage advice, take whatever advice you want, as long as they're qualified to give that advice. So my team told these guys, hey, it's 2020. The government is pouring out a ton of money like there's no tomorrow. And because of all the money going in the market, we're going to see some inflation in a year or two like we've never seen. San Diego has the least amount of real estate relative to demand that we've ever seen. 2020 is a great year to buy, guys. In fact, most agents on my team, myself included, bought real estate in 2020. And this property is going to cash flow $0. And a lot of their friends said, why would you buy investment property that doesn't cash flow? We told these young guys, we said, look, you're buying this cheap. The market's going to rise because of all the economic things happening right now tied to the pandemic and what the US government's going to do. Don't worry about cash flow. You're going to make some wealth through the capital appreciation that's about to come down your pipeline. So what happened? Last year, we sold it for $1.3 million for these two young guys. They made, and they're in their 20s. They're in their 20s. Imagine being in your 20s and making over $400,000 in just over 1 year. That's exactly what these two young guys did. The cool thing is they didn't make that $400,000 through cash flow. They made that $400,000 as a long-term capital gain. Now they couldn't 1031 exchange it because they'd lived in it for a bit and rented a portion of it out. By living in a property, by the way, guys, if you've lived in a property 2 out of the last 5 years, you can get an exclusion of up to $500,000 tax-free that you can make. These guys hadn't lived in it for 2 years. They lived in it for just over 1 year. But they looked at it this way. They said, look, if we split that 410 two ways, that's $205,000 per guy. And instead of having to pay a cash flow income tax rate of 32%, which it would be at that rate, they only had to pay a 15% tax rate on that money. And for two young guys in their 20s to make around $200,000 at a really low tax rate just made sense. And they had a place to live for the year that they were in San Diego. So that's the case study, guys, of how appreciation, doing it right, understanding the market, understanding what you're buying, understanding what you're not buying can make you a substantial amount of money. And here's that tax rate again. Remember, these two young guys, they were both single. So they fell into the single income tax brackets, not the married. And they both made over $200,000, which as cash flow, they would have paid 32% tax rate on. But as a long-term capital gain, they only had to pay 15% tax rate. Now, before we start transitioning to Q&A, I've got one last section I really want to cover with all you guys. And this is something that I've never covered during any of the webinars, and actually something that my team and I kind of just put together in the last couple of days here. But I'm going to present this next example to you all with a question. I want you to read this and I want you to answer the question yourself, answer it within your head, put it in the chat. Either way, answer this to yourself. Building wealth, property A. Would you buy an investment property if it negative cash flowed $11,000 to $16,000 per year? Yes or no? No right answer, no wrong. I guarantee you most people would say no. Because who would want to buy a property that negative cash flows 11 to 16,000 a year? But think about this one for a second. Then the next question, that was property A, and then you got property B. Property B. Would you buy an investment property If it required, and this one takes a little more thinking, think about it for a minute. Property B requires a $135,000 investment spread out over 5 years, though. $135,000 spread out over 5 years. And at the end of the 5-year period, you get $630,000 back. What would you do? Would you take that investment? Which investment would you prefer? I don't know about you, but I like that property B example where I can invest $135,000 a little bit over 5 years, year over year. At the end of 5 years, I get my $135,000 back. I get $630,000 back. That's pretty cool. I would invest in that one. Property A, I'd probably have to know more, but think about this, guys. What if I told you property A and property B are the exact same property, the exact same investment? So what am I talking about there, guys? For that one, and I'm glad it's only 6:12 because I want to spend about 5 minutes on this with you. I want to spend about 5 minutes, and you can probably see a spreadsheet I'm looking at right now called Multifamily Model Duplex Investment Example. Told you my master's degree was in finance, so we can't do this webinar without looking at a little bit of finance and Excel spreadsheet. I'm not going to dive too deep into this spreadsheet, guys, because as you can imagine, let me scroll down. We could probably spend an hour alone looking at this spreadsheet, okay? We're not going to spend an hour on the spreadsheet, but we will spend 5 or 10 minutes because I really want to impress something upon you. And hopefully this helps your way of thinking with investments for the rest of your life. All right, so here's a duplex, 2 units. It's being sold for $1 million. Not surprising, it's San Diego. That's how much we're paying right here on the left. Over here on the right, you see the revenue, the rents. How much rents is this bad boy pulling in? $2,700 a month per unit. Current rent and market rent, $2,700 a month. That's about on par, guys. If you buy $1 million duplex in San Diego, you're probably going to get around $2,700 a month per unit, plus or minus. Okay. Another assumption besides rents, expenses. We would be dishonest to ourselves if we didn't admit that there's expenses associated with running a property. So let's look at expenses. The first is water. And I put in $600 per year per unit. Landscaping, $400 per year per unit. Repairs, $500 per year per unit. And let's say you don't want to manage it. You don't want to manage it. You're going to hire a management company. That management company, you got to pay them 8% of the gross rents. And you got to pay taxes. That's about 1.25% of your purchase price. And you got to pay insurance, $400 a unit, $800 total. And you might want to set some money aside as a reserve account for when the roof leaks, $250 a unit, $500 a year. All right, so that's all of our expenses. And oh, by the way, rent goes up about 3% a year. Vacancy, we're going to assume it's vacant now and then in between tenants, 3% a year. And we're going to assume also if rent goes up, our expenses must also go up about 3% a year, plus or minus. So here we go. We got our revenue. We got our expenses. The only thing I haven't gone over yet is our financing. Unless you're buying a property all cash, God bless you if you are, you're probably using a loan. And in the mortgage market this day and age, let's say you're doing 5% down. Maybe you're going to owner occupy. Let's say you're doing 5% down, $50,000. All right. And you got closing costs. Let's call it 1.5%, $15K. And you got an interest rate, 4.5%. It's probably a little bit high, especially if you're going to owner occupy. It might be able to get a little bit lower. But if you're going to buy it as an investment, yeah, it's probably going to be around 4.5, mid-4s. So we've got all of our inputs now: purchase price, rents, expenses, financing. Now, you and I both know that when you get a mortgage, you got a principal payment and an interest payment. And the cool thing is, if I click on this second tab called amort, which stands for amortization table, we see that monthly payment stays the same, $4,814 a month for 30 years. Principal payment goes up year over year. Interest payment goes down year over year because your loan balance is going down. Now, one thing to understand about principal payment, guys, is that that's not money you're losing. That's money that's being transferred from cash to equity, cash in your checking account to equity in your investment. So you're not losing that money. It's not coming off your balance sheet. Your net worth doesn't come down because you're paying principal. It just transfers from cash to equity. That's a very important concept to understand. And I'll get to why in a minute. So we scroll down here and everything else, we don't have to type anything else in. All these are just formulas that are auto-calculating all kinds of numbers for us to give us year 1 through years 5. And we get our rent on line 52. What's our revenue, our rent? What's our vacancy? Let's subtract that to get our effective gross income. Let's be honest, we're paying a manager 8%. We're paying taxes, we're paying insurance, we're paying operating expenses like water and landscaping to get our total expenses on line 65. We also, after subtracting our effective gross income minus our total expenses, get something called net operating income, NOI. And from that, we subtract that reserve account that I told you about. This gets us something called cash flow before debt service, $41,000 in this case. Now, if we divide cash flow before paying any of our debt, principal and interest, if we divide that cash flow by the purchase price up here of $1 million, we get a really special number in real estate called your cap rate. And there's a cap rate on that property, 4.1%. Again, that's simply your unlevered cash flow before paying any debt, divided by your purchase price. Why do we do it at that point? Because different people use different debt. Some people do a 5% down, some do 20% down, some buy it all cash. So the only way to compare apples to oranges to bananas in the world of real estate is to take the debt equation out of comparing the property's cap rate to another property's cap rate, since everyone uses different debt. Now, in this situation, this person only put down 5%, right? So they got a big mortgage. They borrowed 95% of the cost. Because they borrowed 95% of the cost, their principal and interest payment is $57,762 a year, guys. When you take that cash flow and you subtract your principal and interest payment, you got a negative cash flow number here. Now, this is called, in finance, your levered cash flow. Levered is a fancy word for loan. You're using a loan. So your cash flow after paying off your loan. First year is negative 16,000, almost 17. Next year, 15. Third year is negative 14. Guys, by year 5, you're still negative 11,000. Why the heck on God's green earth would you invest in this property? The short answer is because you want to become wealthy, but let me explain that. So once we look at that negative cash flow, again, most of it's due to principal and interest. We have to remember that that principal payment, you're not actually losing. That principal payment is just being transferred over to equity. And when you bake that principal payment, line 90, back into the equation, you see that big, ugly negative cash flow number? It's not so ugly anymore. And you see by year 2, it's actually positive. In year 5, it's a very healthy $6,700 that your net worth is going up year over year. And we're not even talking about appreciation yet. But the truth is, stocks, gold, just about every investment thing you buy it not just for the cash flow, but for the capital appreciation. We already talked about how taxes play into that and how the wealthiest of the wealthy don't care about cash flow. They care about appreciation because it's taxed at 0, maybe 15%. So when we look at appreciation, guys, we need to bake that back in. Now down here in blue, I put in projected appreciation rates for the next 5 years. All right, I put in 16% for this year. I don't think that's too far off from reality. And I keep a pretty close pulse to what most economists are predicting for San Diego real estate market 2022. 16% is probably a fair assumption of appreciation this year. 2023, it's probably going to fall down to 10%. Maybe by 2024, we're back at the 50-year average for San Diego and around 5% appreciation year over year. And when you look at that appreciation line, guys, which by the way is not taxed, we see that a lot of your investment growth is coming off that appreciation, all tax-free. And your total return is nothing more than that negative cash flow, plus your principal payment, plus your appreciation, and then boom, you get your total return. And this number right here, guys, that is how much your net worth is really going up or down. This line up here, that's your cash flow. Check, got it, I understand. This number here, that's the change in your net worth. Nobody that wants to become amazingly wealthy will invest for real estate for cash flow. You invest in real estate for capital appreciation because that's where the real returns come from, especially when you use leverage, guys. Now, as we add all these cumulative returns year over year over year over year, we see that by year 5, you've gained $495,000, almost $500,000 in return. And all it took was a $135,000 investment to get that 49.5, plus you get your investment back out of the deal. So 495 plus 6 plus 135 equals 630 because you get your investment back out. So would you invest 135 so that in 5 years it turns into 630? If the answer is yes, which for most of you it would be, I understand. But what if I broke it down and I said that $135,000 investment, you have to invest $50,000 plus your $15,000 closing costs. You have to invest $65,000 on year 1. You have to invest $16,000 throughout the 12 months of that first year. You have to invest $15,000 throughout year 2, $14,000 throughout year 3, $12,000 throughout year 4, and $11,000 throughout year 5. You got to invest a little bit every year. But by investing $65,000 up front and a little bit every year, in 5 years, you get back $630,000. Who in their right mind wouldn't do that? And guys, this is how you need to look at finance. This is how you need to look at investment. This is how you need to look at real estate. So often, I meet people that say, I would never buy real estate that negative cash flows. And that immediately tells me that that individual doesn't understand finance, especially when the same individual tells me that they invest in a retirement account. Most of you on this webinar, you probably invest in a retirement account. How many of you have ever invested in a 401k or an IRA or any retirement account? Think about it for a second, guys. When you put, let's say you put $6,000 into an IRA this year, or let's say you put $10,000 into a 401k next year. What is a retirement account? A retirement account is a negative cash flow investment. A retirement account is an investment that you put money into, hoping that money comes back out of it by the time you turn 60, but you're putting a little bit of money into it every year. It's a negative cash flow investment, just like this real estate property is. But there's no way it's going to return to you almost $500,000 in 5 years. And guys, that is the way to look at real estate investment when you're comparing cash flow versus capital appreciation and all the other ways that you can get a return on your investment. So again, it's a pretty complex chart. We went through it in like 15 minutes, 10 minutes. So I wouldn't expect you to fully understand it, but I wanted to at least plant a little seed in your mind to look at things differently. Speaking of looking at things differently, what we're looking at right now is the same fourplex, the exact same fourplex marketed by broker number A and broker number B. And as I said before, most brokers are going to make mistakes and or more often than not leave stuff blank. And you can see broker number A selling a fourplex, guys, worth over $500,000. Doesn't include much of anything in the remarks about why an investor would want to buy this. And in the financials down below, they're simply blank. Then you look over here at broker number B, and you see right away in the first line, fourplex property with cash flow income, one of the highest cap rates in San Diego County, turnkey, blah, blah, blah. It goes on and speaks to investors on why they should buy it. But most importantly, it includes the financials down here in the bottom left. Guys, this property on the left was first sold by a broker who shall remain nameless. My client bought it, owned it for some time, and then we helped him sell it. And this is how we market it. And this, guys, is the starkest example I can show you of how most people do it, 90%, and they do it wrong, and how to do it right, so that you can find and identify the mistakes other people are making and make money in real estate. At the end of the day, as it says at the top, who you hire matters. And I'll close out with that sentiment that who you work with matters in this life. Guys, when you get surgery, the doctor you go to can be life and death. And when you go and make a $500,000, $1 million investment property, the realtor you work with can be the difference between you getting a good deal and a bad deal. You becoming a millionaire and you just becoming everyone else. You decide, but I'll tell you what, I wouldn't work with a doctor just because it's my buddy, my friend, or my cousin that just got out of med school. I would work with a doctor that's the best when it comes to my health. And when it comes to finance, I believe you got to treat the same as your health and your wealth. I would work with those that know. Who you work with matters, guys. This is a photo of my team. We've been ranked consistently one of the top teams, not only in San Diego County, but in the entire nation. Again, we sold about 140 million last year, where your average realtor in San Diego is selling about 4 million a year. Who you work with matters, and most of the people on this photo in front of you have advanced degrees in things like finance, real estate, and operational management. And I'll end it on this note. We'll turn to Q&A. In order to cross the finish line, wherever you want to get to in life, you have to first cross the starting line. And the only thing I have ever seen that prevents people from their own success is themselves. Don't prevent yourself from obtaining your own success, whatever that might be. If it's in real estate, financial independence, or whatever your goals are in life, get over the fear that holds you back. Make the decision to cross that starting line. I'll close it out with my contact info here for any of you that want to reach out and work with my team in the future to buy or sell real estate. We'll be here for you. We'll help you. Hope to see some of you at the future webinars. With that, I'll turn it over to Q&A and go through some of these questions that I see in the chat here before signing off. So Jose is asking, what does cap rate versus cash on cash return mean? How would we be able to understand it if we are trying to start in real estate investment? Well, to show you kind of the difference between cap rate versus cash on cash, let me go back to this example. So your cap rate right here, again, as I explained, is simply your cash flow before any debt service divided by the purchase price of the property. So if I buy this property for $1 million and my cash flow before paying any mortgage is 41,000, 41,000 divided by $1 million is 4.1. That's a 4.1% cap rate. Cash on cash return is your cash flow year one divided by the cash you invested in the deal. And in this example, we invested $65,000 cash, $50,000 down payment, $15,000 closing costs, $65,000. And if I divide my cash return, which is negative $16,000, by a positive $65,000, I get a negative 25% cash return, cash on cash return. You might think that's crazy. You're going to go broke with that kind of cash on cash return. Not as long as you got income coming in from other forms, other avenues, or you have some savings, you'll actually become quite wealthy because you're, as you see down here, you're getting a 250% return on your money, 179%, 102. Because again, monthly cash flow is only a small sliver, and it's the highest tax sliver of an investment's return. Usually the biggest is going to come from your capital appreciation. And this is someone doing a very low down payment, 5%. Let's say you're a normal investor and you do a 25%. All I changed on this entire model was a down payment, 25%. Your cap rate is still going to be the same, 4.1%, but your cash on cash return is going to change, as is your total return, your internal rate of return with appreciation. Now you see this guy's not cash flowing as much, or not negative cash flowing as much. He's only losing 4,000 versus 16,000, but his internal rate of return went down quite a bit because he's not using as much leverage. He'll still become wealthy, but not as quickly as another guy. Now let's say you do 50% down. Now your cash flow is positive, positive 10,000 a month, positive 11,000 a month. But this dude is now only making what, a 35%, 26% rate of return because he did such a big down payment. You're going to cash flow positive, but you're not going to become nearly as wealthy as you could have otherwise, because your internal rate of return is so much lower. In essence of time, if you want to learn more about all that, reach out to myself and my team, and we can hook up a one-on-one meeting with you and one of my team members to go through it in more detail. Marina, you're asking regarding cash out refi, do you have to own or occupy the original property, or can it be rented and purchase another property that you own or occupy? The short answer, Marina, is to do a cash out refi, you do not have to own or occupy the property. Now, let me add on to that though. If you own or occupied a property when you bought it, you got an owner occupied loan, and then you move out of the property. And now you want to refinance it and pull some cash out, you totally can do that. I've done that on many of my properties. But be aware, your new mortgage, your new loan will be classified as an investment loan, not an owner-occupied loan, because you no longer own or occupy the property. And an investment loan has a higher interest rate than an owner-occupied loan. So if you have an owner-occupied loan with a low interest rate on that loan, you can certainly do a cash out refi if you've converted the property to investment property. Just be aware that your interest rate is probably going to go up significantly. Now, if that's the case, you might be better off doing a HELOC, an equity line of credit, instead of a cash out refi. If I had a $400,000 property and a $300,000 loan at 3% interest, I wouldn't refinance that loan to pull out $50,000 or $100,000 if I'm refinancing from 3% to 4.5%. Now, if you only owe like $100,000 on the property and you're pulling out $300,000 or $400,000, then yeah, maybe I would. So it really all depends. But the short answer to your question, Marina, is yes, you can cash out refi any property that has enough equity in it. Doesn't matter if you occupy it or if you don't occupy it. Just be aware, if you don't occupy it, it's going to be an investment loan, not an owner-occupied loan, and that carries a higher interest rate. Marina, what are your recommendations for down payments for subsequent properties? Is it cash out refi? I find trying to save on my own is not enough for a down payment to keep mortgage low. Yeah, so what do I personally do is what I can tell you. And my first 3 to 4 purchases of the 8 I own, I usually had to like save money and use that as a down payment. The first 3 properties I bought, I owner occupied, so I could do a very low down payment. I bought a condo in 2008, low down payment, owner occupied it, moved out in 2009, bought another condo, owner occupied it, low down payment, moved out in 2012, bought a house, owner occupied, low down payment. So that's how I kept my down payments really low, by owner occupying my first 3 properties and then holding on to them and turning them into investments. Now I'm at the point though, and Marina, you will be too, where once you own 3, 4, 5 properties and you've had one for 8 to 10 years, then you do a cash out refi on that one and use it to buy another property. 2 more years go by, so something else matures. You've had that one for 8 years, do a cash out refi. And as long as you buy a property every 2 years, then 10 years from now, for the rest of your life, you will have a property that's hitting like that 10-year maturity point. And by 10 years, you're going to have enough equity in it that you can pull out a few $100,000 tax-free and use that as a down payment on your next property. As far as keeping your mortgage low, every single property I've purchased in my lifetime, negative cash flowed at first. Every single property I purchased, negative cash flow. I could have done bigger down payments so that they positive cash flow. But again, and tied to what I've talked about the last 60 minutes, I don't care about cash flow. I want to be a multimillionaire. And the only way I know to become a multimillionaire, or even better, a decamillionaire, is to have a high internal rate of return. The yellow line that you see on this chart. Now look, I got some significant negative cash flow, but who cares if your internal rate of return is 250%, 179, 102? Now, this same property, I could come in and say, hey, I'm going to put down 40%. All I did was I changed the financing. I guarantee you I'm going to positive cash flow. Look at these numbers, positive cash flow. Some people would be happy with that, comfortable. The only downside is you went from a 250% internal rate of return on your invested money to 42. You might become a millionaire off that, but you're not going to become a deca millionaire, not in one lifetime. Deca meaning have a net worth of over 10 million. So that's why I prefer to do as low a down payment as possible. And I know that means I'm going to negative cash flow. Doesn't mean the investment's bad. The property is the same property if you do a big down payment or a little one. But a little down payment means you're probably going to negative cash flow, but you're really juicing your internal rate of return. So again, I'll put that back to that low down payment, 5% juicing these numbers. This line number 95, this is the line that makes millionaires. Line number 85, cash flow. This is a line that makes people comfortable or uncomfortable. Line 95 is the line that makes millionaires. Let me be honest with you. If you want to become a multimillionaire in this lifetime, you need to learn to be a little bit uncomfortable. If you just want to be comfortable in life, then you might become a millionaire, and you'll always have positive cash flow. But there's ways to become so much wealthier. This is based on finance and Excel spreadsheets. All right, Haley's got a question. Probably not a one-size-fits-all answer, but in general, would you do a 1031 exchange or look to pull equity out of existing properties to purchase additional properties? You're right, that's not a one-size-fits-all, but I can give you a pretty general, pretty much one-size-fits-all, one-size-fits-most type of answer. Is I believe in my business rule, the rules I live by. There's only two reasons. There's only two reasons to sell real estate, Haley. There's only two reasons to sell real estate. One, because you need the money and there's no other way to access it. Well, and you and I both know you do a cash out refi. Or two, to go buy more real estate and there's no other way to access it. So that probably answers your question, but for me to be more direct, I would do a cash out refi before I would do a 1031. I would do a cash out refi. If you can pull the money out, Haley, and do a cash out refi and then go buy some more real estate, do that. Why? Because you have a low tax basis. Any of you that have owned real estate for a number of years, you got a low tax basis in that real estate property you own in California, because the state of California, your assessed value for real estate taxes can only go up so much per year. And you probably got a low mortgage on it too, if you've done a financing in the last year or two. So if I believed in doing 1031s more than doing cash out refis, I wouldn't own 8 properties. I'd probably own 4 or 5, because I would have 1031 the stuff I bought a decade ago. But instead, the stuff I bought a decade ago, I've just done cash out refis. I keep that stuff I own a long time ago, and it just all keeps on growing. I personally will probably start doing 1031s once I get to around 9 or 10 properties, because most lenders don't allow you to have more than 10 mortgages on 1 to 4 unit properties. So to answer your question, Haley, do the cash out refi, not the 1031. Only do the 1031 if you can't access enough cash through the cash out refi. Marina's asking, do you have any recommendations for where I can get a line of credit? I have found that the pandemic limits have been decreased to 510. You can get a home equity line of credit from just about any mortgage broker, mortgage lender, or big bank. And if you're only being offered $5,000 to $10,000 line of credit, I would shop around, because you and I both know that our credit cards can't have more than $10,000 credit line on them, and that's unsecured debt. So I can't imagine a lender only offering you $10,000 of credit against secured debt like real estate when you can get $20,000 or $30,000 in unsecured credit card debt. So shop around, and any lender that my team has ever introduced you to, Marina, most of them should be able to give HELOCs, maybe not all of them. And most big banks will. That said, make sure that you do the right thing. You can either do a cash out refi or you can do a HELOC. And you need to work with a lender that shows you what the finances will look like with both options. For the last 2 or 3 years, a cash out refi made sense all the time because we were in a decreasing interest rate environment. Now that everyone's got rates locked in that you've financed in the last year or two, and now that rates have gone up, it doesn't always make as much sense to do a cash out refi, and it might be a HELOC. Because rates were going down, I saw 2020 and 2021 is the ideal years to do cash out refis. So on all my properties, I did cash out refis, even if I didn't have anything to spend the money on. And I just put it in a savings account, and that's where it's sitting. And I'll go spend it on something in the future. But 2020 and 2021 were ideal years to get a bunch of cheap debt. All right, that's a lot of good questions, guys. And Marina and Haley, I know my team has worked with you guys quite a bit, and I look forward to working with you guys more, and everyone else that was on the chat today. I hope that you guys learned some new stuff. I love putting these slides together. I love putting these webinars together. I learned too. I mean, they say the best way to learn is to teach, right? So I'm so glad that I've been doing this for half a decade now, because there's nothing that I've learned more from than probably putting together these webinars and the research that goes into them. Thank you all again for joining tonight. And it looks like that's it for questions. So with that, I'll sign off, and I'll see you all at the next webinar. Have a good evening, guys. Bye.